ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job
price is algorithmically delivered. That means price is going up and down whether there's a buyer or seller at that price. Let me say that again. Whether there's a buyer or seller at that price or not.
Central banks are the leaders of the world. They control everything. So they're not listening to a president's opinion about something. Whatever you're hearing or reading in articles, just know that that's crap. Don't buy into all that stuff. Trust what the charts are telling you and only focus there. If you start listening to these things, these news wires about anything president says about the economy, stock, currencies, interest rate, all those things are completely moot points. They don't have any basis whatsoever.
Exponentially. Like, it's astronomical amount of risk. And it's important for you to understand that, especially for the U.S. citizens. We can appreciate it. It makes sense to us because it's our presidential election. But for the folks that are outside the U.S., they look at these types of comments and they're like, it has nothing to do with me, ICT. I'm not even an American. But you have to understand the impact of this reverberating through every world country. And the central banks are owned by the same families. And they just put a title on these central banks. Just like the Federal Reserve isn't anything governmental in the United States. A lot of people are shocked when they find that out. It's the same thing as a McDonald's. It's a privately owned company. But yet they're never audited. No one polices them. And they make the rules. And if you don't do what they want, hey, guess what? You're going to get punished by them. It's not the president that runs the countries here. So it's important to understand that these events are perfect theater for them to implement central bank policies. And central bank policies in this environment isn't a gradual thing. It's a sudden thing, and black swan events result from it.
And charting software like we have here, we literally used to have to circle swing highs and swing lows. We call them ring highs and ring lows. When this was done, you would know where the market structure would be, and you would also see where the stops are. This is like a version of that, just with on steroids, because it's building logic behind the fact that the market's going to draw to these levels to facilitate trade. Now think about it. If the market is controlled by the central bank, they're setting the price every single day. They're moving price up, they're moving price down, and long-term interest rates are drawing price to a specific level, value-wise, fundamentally. But who's in control of the interest rates? The central banks. So that everything is controlled by them, okay? The data in and the output is controlled by the central bank. So if they are in control of every facet of the information that we use to make decisions to trade with, remove all the other stuff and just focus on where would it make sense for them to go with price. Where's the majority of the interest at right now? It's below this low.
This is what they would do before it started going electronic. Right now, from the central bank level where the market's feeding you price, that's all predominantly electronic now. There's really very little human involvement. It's all basically algo, and they just know that these same principles are at play all the time. But it started with a human element. So at the central bank level, this is what would happen. Before we went to electronic, a big bank would communicate with another big bank, okay? And they'd say, look, I got a large block that I can push in the marketplace, but I want 112.35 or better, which means that the other bank will look at their book and say, okay, do I have anybody that wants to buy at that level or higher? I know I want to get price at 112.35 because if I do that, if I can get one print from the market, one trade prints at 112.35 or higher, if I can find another bank that will take the other side of that trade, together we will blow out these stops over here in this orange area. So what I'll do is I'll call around to a bank, because all the banks work together. Say, hey, look, I got an offer at 112.35 or better. Do you have any takers? The guy at the other end, another bank, he'll say, okay, let me see. He'll go through his book. Is anybody who's willing to buy up there? And he'll say, yeah, I got a buyer. Boom. I'll put the order in the marketplace. He'll pair his party with that. The market will print. It'll jump up real quick and shoot up there at 112.38 or 112.35, whatever the order is that they agree on. They pair those orders up together. As soon as the market prints that, your charts will reflect that that's where the market's gone. But to us, it looks like it moved supersonic speed. And Chris Laurie will say it's a lack of liquidity. It's not. It's not that. It's actually a higher pairing of big, bulky orders, a large volume of orders. The market's going to go and facilitate that trade immediately at the interbank level. So when it happens, it causes this huge gap. And it looks like to us it's speed. And it is speed. But what it is they're taking those orders and they're pairing up a large block, which will cause cause the print in the marketplace. And then once price is traded there, once it prints, any order over here becomes hot and then becomes a market order to buy at the marketplace. And it floods the marketplace with sell orders to be paired with those buy orders. In other words, anyone that's long down here, when we get to this level here with this opportunity that used to go on when it was non-electronic, that would facilitate that run on the rate of stops. And it's the same thing that the pit traders would do in the floor of the S&P and the bond market. It's still, it's still the same premise. Find a willing participant above an old high to match with, and you'll gun the stops. And when that happens, it creates a rush of orders that come right in the marketplace. And you can do what? You can sell all your long positions here to willing participants to buy at a really high price. And it's engineering liquidity. It's all it is.
If it's going to go up, why is it going to go up there? There's orders up there. It has nothing to do with any other Mickey Mouse fucking patterns that may be below that. That's your religion. That's what that is. You have a cult-like mindset if you believe in supply and demand, Elliott wave, harmonic patterns, animal patterns, trend lines, moving average crossovers. None of that shit is the catalyst for why price went up there. The orders resting above those fucking highs, that's the real reason why. There's no other reason why. Zero. You honestly fucking believe that these investment banks, these large funds, these firms out there are literally swinging on the hopes and fucking prayers of these animal fucking harmonic patterns. You really fucking believe that? Like, really? There's billions of dollars being shuffled every day. And you think, honestly, that shit is what they're using? These fucking people laugh at that stuff because it's nonsense. There has to be scientific, something tangible behind it. And you're always looking for where the algorithm is going to seek where that liquidity is going to be. Again, the algorithm cannot see the orders. It doesn't see the orders. That's not what this is. It's a facilitation of taking price to that level, so therefore the bank traders can make a run on the orders because they can see those. The algorithm cannot see the orders because the orders are always changing and they're in different pools of liquidity. The algorithm's job is only to deliver price to that level for efficient price delivery. It's not taking in or out orders. That's done at the bank level. That's why those traders are there. When you look at UBS and you see that big old floor of traders out there, there's a mass, it looks like 3 football fields out there. When you look at that, those people are executing on these opportunities that the algorithm presents for them. They are not the ones driving price. See, that's what is permeated in this industry. You got folks out there that are well known in the industry, and I'm not going to beat anybody up, and believe me, if I'd listed them, you would know who they are. They'll say, ICT doesn't know what he's talking about. It's this, it's that. It doesn't do this, and there isn't any algorithm. There isn't any market maker. There isn't any of this. And I know somebody works at the bank. Well, you don't know what you're talking about, and they don't know what they're talking about because the folks that are actually executing, they are driving those individuals on the floor that you see at UBS. Those traders are not looking at the chart and saying, oh, there's a harmonic pattern. Let me go in here and trade that. That's not what's going on. They are getting orders on how to execute and what levels they have to process on. Where do they get that information from? Their bosses. Where's that coming from? The algorithm has already determined what the daily high and low is going to be for the week, for the month, for the day, for the session. It's already in there. So when they know by looking back where that liquidity pool rests, where that fair value gap rests, where price didn't deliver efficiently, that's going to be an opportunity for the traders to execute on those levels. Now, they have analysts that'll pass down to the traders, okay, here, look, here's our order book for the day. We need to execute and process this. Okay, so the trader, when he goes in here and he does these orders, he's not pulling out his indicator-based logic, or he's not looking at his techniques. He's executing on orders that he's told he's got to execute on. That's the level of trade. That's the trader I'm talking about. I'm not talking about the prop firm or the guy that wants to be a fund manager and prove he's smart and all that. That's not who I'm referring to. There's an hierarchy in how this works. The algorithm provides the means for the orders to be taken in or taken out. Algorithm doesn't do anything about knocking people off. It's just moving price to where it needs to logically go to allow these orders to be bumped or entered. Long term, IPTA still has to bend to a fundamental decision on what interest rates are doing. But near term, it's always going to gyrate around to the closest liquidity pool or institutional reference point. Like we talked about, old highs and lows, bearish and bullish order blocks, fair value gaps, equilibrium, and voids. That's it. But it's going to draw to levels that are logically and easy to see when you look at like I'm teaching. The algorithm doesn't see it visually because it's a computer program. Okay, so it has to have reference points. This is not knocking out a hedge on this little move here. No, it's not. The price is seeking liquidity and offering it to traders. Okay, it's not meant for you to trade off of. IPTA moves down to areas like this to allow bank traders to trade there. The misnomer is banks do this. They go, okay, I'm going to put price it's here and I'm going to run that. No, IPTA's doing that. IPTA will run to areas of where the bank traders, they have to still be on point. If it was completely automated, they wouldn't need bank traders there. It would just be completely autonomous. IPTA moves price to these levels, and then the human at the trading desk, they have to execute when it does this. That's the behind the curtain environment that no one talks about. That's what's going on. So if the trader does not execute efficiently, that's why traders get in trouble, because they either over leverage or they don't execute well. They aren't doing what they're supposed to be doing, and they're thrown out the position. They get rid of them. Well, the question is, IPTA moves price, not the banks. Well, who made the algorithm? The bank. It's a method of facilitation that has the opportunity for the human element to see what's available, and they can take that in consideration. In other words, if I know that the algorithm will move to this level down here, okay, when price gets to that level or about to trade to that level, the traders at the bank level, not your mom and pop bank, not the guys you hear about on YouTube channels, okay, they have the opportunity to see what's available right there. Price going down to that. IPTA doesn't know how much you have in your account placed on that trade. It's not seeing you, but it does see where price has had a movement away from in terms of time and in price. So if we know that there's a likelihood of price going down to a logical level or PDA, then there is the opportunity for the bank trader to execute at that moment. Now, at that very moment here, they may widen the spread a little bit. That takes out a fund. Now, I'm not saying there's a fund having a stop loss here, but that may occur there. At that same time, your broker that you trade through from a retail capacity, they in tune also will spread that dealer spread open too and snag your stop based on that you're in their order book. They can see that your stop loss is there. So the spread will widen. I mentioned this the other day when we were talking. That's what Oanda did. They gave me a fill that was completely outside the range of even their spread. I didn't argue about it. I just collapsed the trade and moved on to the next thing. I didn't see any more funny money stuff with them outside of that one. But your dealers from your broker will work in that same model where if IPTA, they don't, first of all, if you talk to anybody at Oanda, any retail broker, they have no idea what IPTA is. They'll say that doesn't exist. I've never heard anything about that. Okay. But price is being delivered from the algorithm at these levels, and the traders are given the opportunity to trade at those points. Price can go to a level and there may not be any trades executed there. The delivery of the content will lead you to your acceptance to the fact that there's no way, as long as the markets are going to be trading, there's no way this is going to stop working, because this is how the market works. That's like asking the car to stop being a car. You know, when you put the key in the ignition, you turn it, it doesn't suddenly turn into a horse and carriage. It's going to remain being a car. And that's a stupid analogy, but that's the same thing. It's absurd for us to think that this is not going to continue working, because it's exactly what the whole process is. Casinos are not going to start selling baked goods. They're going to deal with games of chance. That's their business model. Well, the banks, they deliver price. That's their business model. So don't think and worry about whether or not, it's just going to continue working or not. No, it is. It's absolutely going to. This is never going to stop working, ever, until the entire financial industry collapses. That's the only time it no longer works, because this is how price has to be delivered. There's no way for a liquidity provider to be efficient without this framework. It doesn't work for them. It won't work for them. It won't work for any other entity. It won't work with another business model. There's no way to do what needs to be done outside of what's being done here and how I'm teaching it. So don't worry. It's going to just be like this until it's no longer available at all. Can they change the algo? This algo is not like a prop shop algo where it tries to trade patterns. When I say algorithm, you're actually hearing me refer to the price delivery mechanism that comes directly from the central bank. So when we receive price, it's being offered by them in a basis that's relative to